Friends, in this video for ithought Advisor, I am going to talk to you on the topic making every portfolio succeed, whether in the role of an investor or as an advisor or as a portfolio manager. I have always felt that every portfolio can be made successful. Whether you started at the bottom of a bear market or at the top of a bull market, every portfolio can be made to deliver reasonable investment performance to the investor. Because at various circumstances, I have myself invested as an investor and seen that portfolios which started in a bull market or at the peak of a bull market still did well by the time you had the next bull market. How did this happen? Because you also see a lot of investors come into the market at one market top and then lose patience by the time the next bottom is reached. So many investors have an investment experience only from a market top to a market bottom. How can you make such portfolios succeed? Let me add another set of investors to this. There are many people who start from a market top, then wait it out till you go to a bottom, and then when the portfolio comes back to cost, they leave. So they make no money. So we have two distinct set of investors, one set who makes losses and exits and another set which barely recoups capital and exits. How can we make those portfolios also succeed? Because at the end of the day, an investor deserves success. Every investor deserves investment success. So whether you're a friend telling an investor how to invest or an advisor telling him how to invest in your professional capacity or a fund manager who takes responsibility in a fiduciary capacity, you have to ensure that the investor wins, he gets a good experience. This can be done by ensuring that the investor participates in all types of markets. He may start at the peak of a bull run, but he must continuously participate as the markets come down. He must participate when the market hits a bottom, and as the market comes up, he must continue to participate at every level. If you ensure that this happens, by the time the markets even come back to where he originally began his journey, he would be in profits. So along this curve, he would have invested enough money and would be in profits. So you would ensure that where he began his journey actually doesn't affect the outcome that much. If you want every investor to succeed, you have to ensure that he participates continuously. And as an investor, if you want to succeed, you must participate continuously. You cannot start with a big sum, a big bang, and then do nothing, and then hope that market will take care of your timing risk, which was at a market top. Many people don't realize that even when the portfolio is at a loss, if they add 10 or 20% capital to their original corpus, that amount alone can swing the fortunes of that portfolio. Instead, we see investors and managers, stroke advisors, keep arguing on what has happened between a market top and a market bottom. As an investor, I can assure you, only one thing happens between a market top and a market bottom. You notionally lose money. It's not a real loss, but your portfolio will be down a bit. How much it is down depends on the risks you have taken in your portfolio. Sometimes it could be less than what the benchmark index has fallen. Sometimes it could be more if you have taken the choice to invest in a higher risk small or mid cap portfolio or even a micro cap portfolio, or maybe a blend of all these things. So what you own determines how much you are down. But I am sure that that is more a factor which is temporary. It's a notional loss. If you invest more money when you see this notional loss, your fortunes could reverse and you could actually make a real gain over a period of time. I've seen investors who put 100 rupees who have gone to 80 when the market has gone from 100 to 75 or 70. I always tell them, just fill this gap. You have lost 20 rupees, you invest another 20 rupees and wait it out. This 20 rupees will ensure that your portfolio comes back faster, because whatever you're investing now goes into all the right places at the right valuation. And the stocks which are down today will recoup your losses and at least take you to where you began. Investors think that they give the managers money and refuse to give more money when the markets are down. This is something I found very vague and weird actually. An investor is actually giving his own portfolio money. The manager is administering it with decisions. The advisor is giving advice. So the money doesn't go to the advisor or the manager, it goes to your portfolio. And when your portfolio is not doing as well as you like, you should give it more attention. Let's say you're growing a plant. It looks a little bit dried up. What do? You immediately nourish it. You ensure that there's enough air going into the roots get enough oxygen. You ensure that there's enough water. You give some soil nutrients so that the soil becomes better. And you keep a close watch on the plant till it shows some greenery and it looks in better shape. The care that you give a plant must be given to your portfolio. If you do that, then that loss which you saw in your portfolio, which is like a dried plant, will turn into greenery. That attention and nourishment is what most investors who fail don't give to their investments. If every investor understands how to nourish his portfolio in bad times, when good times come back, success will be his fellow traveler and companion. The investment journey itself gives you a lot of opportunity like this to nourish your portfolio. Give it more attention, care more for it, and keep a close watch. In bad times, what you do to your portfolio is going to give you results in good times. Simply waiting and watching in bad times and telling everybody that I will invest only when my portfolio comes back is not a smart thing to do. That's not what good investors do. So just because you're advised by an advisor or your money is with a manager, don't take that path. There is of course the issue of whether the strategy of the manager or the advisor suits you. But that is something that you should make sure before you begin the investment journey. You don't begin the journey and then go down and then evaluate whether that strategy suits you or not. So do your homework before you begin the journey, and once you're on the journey, you believe in reaching your destination. Don't stop midway, sit on a bench and say that I will wait for time and then do my journey when I feel like. That means that the time you already invested is wasted and you're not actually going to a better place. Give more attention, show more confidence, nourish your portfolio with more capital. Results will follow. Thank you for watching this video.